think on the Nifty itself, it's a flattish start to kickstart trade. Yeah, we are just getting it in. The bell rings and the first rates come up for us. Yes, so it's a flat start on expected lines, but individual stocks are doing well. SBI Life continues to see its run that we saw yesterday as well. It popped up in trade. Coal India is up close to around 1% or thereabouts. On the flip side, the Nifty Bank, well, that's pulled back close to around 100 points. That would mean a couple of banking names are lower. ICICI Bank, Axis Bank, both of them are a little lower in early morning trade. While in fact, you have a couple of these large IT names as well that are pulling back a little bit. Nothing too much to worry about, but Wipro as well as TCS in the red. So we're holding at around 19,550. The first tick itself did see some bit of selling coming in there, but the breadth of the market is pretty good, with 1,500 stocks advancing for 1,400 stocks that are declining.
Let's take you through some of the mid-cap movers then. GSFC has straight away opened with a cut of about 5.5%. The numbers are weak. The company's reported a revenue decline of 32%. Margins have contracted. Profits are down 80%. And like in the case of chemical companies, this fertilizer name too has opened on the back foot. Brigade is quite weak in trade, and so is Idea Forge. Remember, Idea Forge, numbers were very, very disappointing. Profits are down more than 50%, and the stock is lower by 4%. Adani Wilmar, on the back of that Bloomberg report about a possible stake sale by the Adani, parent company, Adani Wilmar is down nearly 3%. Prestige's numbers look pretty okay, but then we already have the operational update in. PB Fintech, Macquarie initiated coverage. They've got an underperform rating, and PB Fintech is a bit subdued in trade. Oil India opening on the back foot. On the gaining side, you've got Phoenix Mills, that's higher in trade, of 50% plus top line growth. Data Patterns numbers look pretty good. The company is guiding for a 20 to 25% top line growth. Minda Corp, there was a big block deal which took place yesterday, a clean out trade, and Minda Corp has opened up in the green. EIH, Dhampur, Tilak Nagar Industries, these are some of the mid-caps which are reacting positively to their earnings. Gland Pharma is one of the other big movers. It continues with its gain from yesterday. Gland Pharma has opened up 7%, and remember, it was up nearly 20% in yesterday's trade. On the losing side, Utkar Small Finance Bank, I think it's the first time post the listing that we've got the numbers, don't look pretty strong. But, at the index level, things are very quiet, just down 0.07, 0.08%.
Yeah. Gland Pharma is really the stock of the morning once again for me. Its re-rating has been nothing short of breathtaking. 20% yesterday, 7-8% again this morning. Market's extremely excited and really hopes that what we've seen in Q1 is a bottom for the business. So that is straight away a stock in focus. Otherwise, the problem area for the market really are banks all over again. You had that one promising day yesterday, as Nigel was pointing out, where the Bank Nifty was finally outperforming the Nifty. Today, you've gone back to the same script. Actually, for the market, there are three critical areas. One is the Nifty Bank, where there is weakness. The second is IT. IT is not off to the best of starts this morning. Look at HCL Tech, Wipro, LTI Mindtree, TCS, Infosys. All these stocks are dragging. They're not down too much, but they are down between 0.25% to 0.5%. So need to watch for IT, need to watch for banks, and then there's Reliance. So three problem areas for the bulls this morning. Let's see how each of them behave. In terms of the counters, it's actually back to the old-fashioned safety, which is FMCG and pharma. Reddy's, Sun Pharma, these are names on the upside. Britannia is managing a bit of a gain. Nestle. So FMCG, pharma up. Banks, IT, Reliance need to watch. The Bank Nifty at 44,840. The 50 DMA, which is sort of your first next support zone, which people will talk about, that comes in closer to 44,700, 44,690, 44,700. So we're still 150 points away from that support zone. Let's see if the Nifty Bank can find some stability. We have Mitesh joining in. Mitesh, actually, before we talk about the market, can I throw Gland Pharma at you? I don't know if you sort of had the time to notice the move yesterday. The fundamental news is out and we've been discussing it ad nauseum. But on the charts, I mean, is this looking like there's some sort of a more durable move that could be in the making?
Very much, Survi. In fact, yesterday you couldn't have missed the stock. I think the way it was, attracting attention, big gap up opening and then circuit up as well. I think the stock has definitely changed the medium to longer term trend, and the targets now on the upside would be 2070 to about 2200. So these are the two levels which I'm watching on the upside, which gives us a significant upside. The only worry is the 28% rise which the stock has already seen in this week, and therefore you might not want to buy it immediately. Maybe accumulate slowly, buy about one third or 40% quantity over here, and then wait for levels closer to 1600 to enter afresh. I think the stock is heading towards levels of around 2070 to about, and then even at 2200 as the targets for the next few weeks. So very, very positive over here. The thing is that tactically you would want to define your entry well.
Mitesh, do you think the markets are just waiting for cues in the form of the RBI policy, the US CPI inflation to get some direction? Or do you think we're in for a longer period of time correction, a consolidation which is going to last a little bit longer? What's your sense reading the charts?
I think should be Rima, an event like that could definitely, in the short term define a trend. So the initial feeling is that this looks like more of a time-wise correction. And while, I'm looking at lower levels, but I'm not looking at very deep cut over here. So my sense is that we might actually get to about 19,400, 380, which is a level which we already tested last Thursday. And maybe, in the worst case scenario, 19,200. So as of now, looking at 19,200 as the lower end of the range and about 19,800 as the upper end of the range. So then we'll get into some kind of a sideways consolidation once this pullback to about 19,200 plays out. So I don't think, initial feeling is that I don't think that we are looking at a bigger trend reversal, but an event is always an event which could, which has the power of changing the short-term direction. So for the timing, the initial feeling is more of a time-wise kind of a correction, but then let's see how the event plays out.
Okay, by the way, we need to watch out for PB Fintech. Let's put it up on the screen because on my screen, stock's still down another 4%. Remember, PB Fintech sold off very sharply yesterday after numbers, which look kind of all right, but the market has other worries on its mind. Stock's down 4% today. And those worries have been very properly sort of, spelled out by Macquarie in that note that Abhishek was just telling us about. What's the worry? The worry is that you will get a big government set up entity or basically a public entity, which could be a disruptor when it comes to selling insurance online. Bima Sugam, I think that's the name of this architecture. If it comes out, if it's a UPI or ONDC kind of an architecture, then can it really disrupt the business? Macquarie is saying their earnings are 30% below street and 30% below what the management, the PB Fintech management itself is guiding for. So this is a note that really stands out loud in today's market action. Mitesh, technicals, stock has had a dream run. It's the best performing internet platform stock in the last 1 year or this year, very, very easily. Let's pull up a 1 year chart on PB Fintech. And now suddenly there's a lot of selling coming in. What are you making of it?
So again, Subi, I think this is one stock, which went through correction from listing highs of about 1,400 to as well as levels of around 380, 370, and then gave a bigger trend reversal. Now that movement started from sub 400, took the stock to about 800 plus level. I think the first leg of up move in the longer term chart seems to be over, and the stock could go into some kind of correction, pullback, consolidation, etc. The first level I'm looking at is around 700. And if it breaks that, then in the worst case scenario, I'm penciling in about 660 kind of level. So the long-term charts remain very healthy, but in the short term, the stock was extremely overstretched. So I think some gains have to be pruned out. And this looks to be a situation when the stock will go to 700 to about 660. That again will be a very good entry point for people who are into long-term investing. I used to hold the stock earlier in my portfolio, but I think now I've just taken profits 2 days back. And now I think it's giving me the chance to re-enter again.
Okay, so all right, stay invested. Basically, buy back in around 700. That's the advice coming in from Mitesh. Mitesh, got that. Thank you. You have a good day. We'll connect later and get some more inputs on the market. Well, that's a lot of technicals. Market, by the way, Bank Nifty continues to be the problem area. That is the index, which is down about 0.3%. Let's get to fundamentals then. Ashwini Agrawal, founder and partner at Demeter Advisors, is with us. Ashwini, good morning. Great to have you on the show. We're in an interesting market. Indices trying to hold on to these near all-time high levels, which is 500 points shy of that 20,000 mark on the Nifty. But there's a lot of chatter on the horizon. Global issues, US banks, China data. We're running into a policy. What do you make of all this? And is the construct for a continuation of the up move? Or would you say that probably it's time to consolidate a bit?
So, we should think about it. We've had a very sustained run from the end of March. It's almost 3.5 months long, which is very long as a minor bull cycle goes, and we haven't had any meaningful correction during this period. The narrative has significantly changed in India's favor in the global context, which has obviously attracted a lot of foreign capital. But at the same time, if you think about the fundamentals, the earnings direction has kind of either kept pace or in some places fallen short of expectations. Even if you look at the June quarter results that have been released till now, I fail to find too many spots outside of banks and financials where there have been meaningful positive surprises from the underlying expectations. As you point out, that the global narrative is starting to get a little more iffy, and with valuations having become stretched and the earnings environment not delivering that many positive surprises, I would venture to think that we are in for a reasonable correction. Now, whether it will be a time correction or whether it will be a deeper one-step correction, only we'll find out. And it will be driven by an event that we can't forecast. But I think the fuel for a rally to 21,000 or something along those lines, or 2,500, it's not there. It's not there, at least in my mind.
Ashwini, why? I thought pharma numbers look quite good, right? Whether it's Sun Pharma, Mankind Pharma, Gland Pharma, of course, the kind of re-rating it's seen in the last 2 days. You've been bullish about pharma. I remember in a previous conversation, you had spoken about how you would tactically allocate some money to pharma. Your thoughts on the pharma numbers, and have you topped up your exposure given the positive surprise?
So Rima, you're dead right. Okay, and I was kicking myself for not having bought as much pharma as I should have. It's the single largest exposure that I have in terms of a sector exposure. But there's nothing like hindsight to tell you that one should have owned more. I've been quite positive on pharma for a long time, for about 1.5 years or so, and it's been painful going for a lot of that period. But it's very heartening to see, the kind of earnings flow, fundamental information that's coming through about pricing environment in the US and so on and so forth. In the midst of valuations which have been actually quite attractive across the board. So I continue to feel fairly positive about pharma, and you're right, the earnings flow in pharma as a sector has also been on the positive side compared to what the expectations were. Gland Pharma, which is something that I own, hasn't done anything spectacular in the June quarter, but the expectations were so muted and so beaten down that the market's reaction to those numbers has been astounding. We must remember that the stock had actually been offered to the public at 1,490 almost 3 years ago, went up to 4,000, came down to 1,000, which is a steep fall. So I think somewhere pharma is a situation where earnings are fine, in line with expectations, slightly ahead, but I think the market sentiment was too beaten down, and it's the correction in the market sentiment which is leading to these very sharp rallies in some instances.
Just to get that point clear, pharma is your single biggest sectoral exposure currently?
That's correct. That's correct.
Okay, so more than banks, more than any other, manufacturing is a big theme.
That's correct.
Okay, interesting.
Hi Ashwini, good morning. Good on you that you got that pharma call right. Must be feeling good, right? I mean, Gland Pharma, the stock in May. If I just take a look at the low then and the high today, it's doubled. So you would have been somewhere in that vicinity. So good on you. But I was more concerned about your starting comments that maybe in fact we are in for a correction, a price or a time-wise correction. Time-wise, I think that's fine. But price-wise, what would be your best guesstimate? I mean, in terms of, since most of the positives have played out and we're running a little bit less on the, on fuel to take us to 21,500 odd. So what would be your guesstimate? I mean, could we see a 5% correction?
I have no idea.
That would be powerful.
Nigel, I have no idea. I wish I could tell market direction as accurately as you believe I may be able to. And if it were the case, I could make fortunes. But I have no idea. I can only tell you that, look, the fuel doesn't seem to be there in the tank anymore for the market to take Nifty to 21,000 or 20,500. Because in terms of fuel, what we need either a beaten down sentiment, what we are seeing, fuel the pharma rally, for instance, or you need, a significant earnings momentum, which is way ahead of expectations. We are not seeing that. Or you need a significant underweight in the asset category on part of one investor base.
Okay.
None of it is there. So how can we expect a huge rally? So if we can't expect a rally, we should expect a decline, is my simple logic.
Okay, all right, Ashwini, we appreciate you joining in, and maybe we could be in for a bit of a corrective or maybe a consolidative phase. Appreciate you joining in and giving us those views, and take care. I believe you're down with a bit of a throat infection, so please take care of yourself. Well, let's move on. Let's focus on Hindalco. Well, the company reported a good operational performance. It was better than what we were working with, despite some challenging environment. Their aluminium business did not see compression as the street was expecting. To understand about the performance of the past quarter and the way ahead, I caught up with the MD, Mr. Satish Pai, and started by asking him about the price outlook as well as the aluminium business EBITDA per ton outlook. Let's hear him out.
Why we continue to perform is that I think the most important thing is our costs are moderating. So in Q1, our cost came down by 2% versus Q4, and we think that the cost will come down another 3% in Q2 versus Q1. So whereas the LME, I think, is going to remain range bound between 2100 and 2300, if the costs are coming down the way we said, we should be able to maintain that $700 per ton EBITDA levels that we delivered this quarter as well.
Okay, all right. So that's pretty good news. So we got one variable, that's the cost cooling off. Out of your total quantity, could you tell us what is the hedging policy? We just want to get an updated number. How much of your quantity is hedged? At what prices? That'll give you some cushion as LME prices have corrected a little bit.
Yeah, I mean, there's been no change in our hedge position because the LME has come down. So we have about 11% hedged at $2,755 a ton. And with these current levels of low LME, we have not added to that hedge position rate.
Got it. All right. So that is status quo. The copper business, that was a pleasant surprise. We were chatting the last time as well. You said there'll be a bit of a shutdown, but it appears you'll have sourced copper cathodes from outside and then converted it into CC rods. And that's what's helped the profitability. Now, given that the plant is up and running, what can the EBITDA per quarter look like from here on? In the past quarter, you're surprised with an EBITDA of around 530 crores. From here on, what's the run rate?
Yeah, I think that, look, the first thing we have to realize is that because the copper demand in India is extremely strong, because of the electrification drive, etc. So that is why, to meet our customers' demand, we imported a lot of copper cathodes, converted it to rods. So I think going forward in Q2, you should see an EBITDA much better than in Q1, more near the 600s, because we are going to be using our own cathodes.
Correct. Novelis as well, good improvement out there. It's improved from those low levels. Give us a couple of numbers. The EBITDA per ton, you tell us that in quarter 4 it will return to normalized levels, that $500, $525 per ton. But in the coming quarter, what should be the broad range of EBITDA per ton? And also for the second half of the year, on an average, what will Novelis's EBITDA per ton look like, given that destocking is almost done and dusted?
See, we are now, last Q1, we ran at $479 per ton. So I am fairly confident that in next quarter itself, we should be getting close to the 500. And I think that that is going to constantly get better. So we have guided that by Q4, we will reach 525. I wouldn't be surprised if we reach it in Q3 itself.
Wow, that's quite optimistic. Then the street will like all these sound bites that you're giving us. Aluminium EBITDA per ton closer to around $700. Copper moving to around 600 crores on a quarterly basis. And Novelis, that could be a surprise. Maybe that 525, we see it earlier than what we thought earlier. But that brings us to the debt number. Operationally, you've given us a fair bit of guidance. The debt number, well, it moved up a little bit because working capital went up. Also, you have capex plans. So what should the absolute debt number look like, say, by the end of this year? And also, if you could, revisit the capex plans, both at Hindalco as well as at Novelis.
See, our gross debt, or the Indian gross debt, is roughly around 12,000 odd crores in the long run, long-term debt. We have not increased that. So as you said, the total debt looked a little bit higher because working capital block was there in Q1. And that was largely because of the copper side, where we had to import these copper cathodes. So it led to a little bit of working capital block. So we have no intention of adding to our debt lines. And I think that the net debt to EBITDA by end of this year will be back to, we ended last year at some 0.33. We are going to be in the similar range at the end of this year as well.
Correct. All right. There's been a lot of excitement on Hindustan Copper. Now, there will be various reasons from that company's point of view. Maybe they're doing a bit of management change. Maybe there's far more demand. Well, time will tell. But since, you could be one of the possible buyers out there, and you have said in the past, if it's offered, you'll be interested. Has there been any movement on Hindustan Copper?
Not yet. As I said, whenever the government decides to do anything, we will be interested, but nothing has happened yet.
But there's been no movement whatsoever, because for the past couple of quarters, you'll have been telling us that if there is an opportunity, you'll be interested, but there's no movement whatsoever?
No, not yet.
Okay, all right. What about Vedanta's unit, the Tuticorin unit that possibly could have been up for grabs? Have you looked at that one?
Not really.
Okay, let's wind this down then with the capex plans for the year. You just want to revise that. I think it was 5,000 crores for India. And for Novelis, I think it was around $1.8 billion odd. Any change to those numbers?
No, there's no change. I think that, most of the projects are ongoing. We have a strong balance sheet. We have the cash flow. So we will continue with our capex plan exactly as you stated. So no change there.
That's the big voice coming in from Hindalco. Let's move on and talk about Shobha. Now, Shobha Developers reported a good set of Q1 earnings. The numbers came out 2 days back, but we already had a sense of the numbers given the Q1 operational numbers. It's the 5th consecutive quarter of record high bookings. Pre-sales jumped up by 28% on a year-on-year basis, and realizations have improved very sharply, A, due to price hikes, and 2, a change in the product mix. The company is now selling far more luxury homes, which has helped boost their realizations. To discuss their Q1 performance, we're joined by Jagdish Nanigenini, the MD of Shobha. Thank you very much, sir, for joining in. Let me talk about your high-end segment. The way your product mix is changing towards premium is very staggering. It's happening at a phenomenally fast pace. I believe your high-end segment is now nearly half of your sales, and this number was about in the mid-30s in FY23. Can you tell us the growth that we're seeing in the high-end segment? What will be the split going forward? And what are the margins that you enjoy on the high-end segment, the luxury space?
Thank you. Thank you for having me on your show. You're right. We had the 8th straight quarter in which we did sales better than the previous quarter, and which is in this quarter specifically, it's even better because we didn't have any new launches. Our teams across the country have done a phenomenal job at it. The performance especially is due to a combination of 2 factors. One is our geographical diversification that we had, where we have inventory in 11 cities. And second is due to the change in the mix, like you have observed, from the mid-luxury to a slightly high-end luxury segment. This change, and hence due to this, we have crossed for the first time 10,000 rupees average price realization mark in this quarter. The mix is also because we have seen the trend of larger home sales early on, and we could change our mix in our own design, and that has helped us. And second is also you have seen that more than 3 crores ticket size, which is contributing 37% of our sale in this quarter. About 2 years ago, that was less than 5%. So that change in the mix has worked out really well for us.
All right. Hi, Jagdish. Good morning. Well, you must be feeling good, right? Good traction on ground. Inventory levels are lower. Launches are being picked up. But as you said, in the first quarter, there were no new launches. But do you think, going by what you have done in the first quarter, you will be able to exceed the 15-20% pre-sales growth that earlier you were guiding for FY24?
Well, we aim for the best numbers, Nigel. But like we had been anticipating good set of launches this financial year, and hence we thought we could do those numbers. Some of the launches are slightly delayed now, so but still we would try to achieve those numbers. But it is all dependent on, like I had mentioned in the investor call as well. It is all dependent on the our ability to do new launches.
Okay, so would that mean that you can, deliver on your guidance of 15 to 20% pre-sales growth? I think that's the guidance for this year. Are you on track, or given the traction that you're seeing so far in the first quarter, you think you can maybe even do better than 20%?
I think we are mostly on track for trying to do that. It's very tough to predict for the next 3 quarters, given the nature of the launches and the timelines for it.
Last year, I think your sales were 5.6 million square feet. In the call yesterday, you've laid out a medium-term ambition of 8 million square feet. What's medium term? Do you think it will take you 2 years? Do you think it will take you 3 years? Or maybe even longer?
So we have been seeing, we are in the 8th straight quarter of increased sales, and we did about 5.65 million square feet last year. This year we would like to better it, and we would like to be a consistent performer with balance, with where we have a balance of growth and profitability. Given that, and also we are building up our pipeline inventory to achieve these numbers. So from a timeline perspective, I think it's a little too early to predict as when those would happen. But I'm sure we will reach there. When I say medium term, maybe 4 to 5 years.
Okay. All right, Jagdish, for a real estate developer, and from the time that I've been looking at it for the last many years, is sales is a very good friend, but debt becomes an enemy, and you have kept that enemy far away from yourself. I think your debt number as we speak is at 9-year lows. Could you tell us what is the trajectory on the debt front from here on? You'll require some funding for new projects as well. So where does this debt number move up? Do the promoter entity have any kind of intent to pump more money into the company?
Yes, Nigel, we have a very laser sharp focus on our cash flow generation, and due to which we have the 11th straight quarter of debt reduction and net cash flow generation. We are at almost half the levels of our peak debt, which was in FY21. And this has really helped us in improving our financial structure of the company. And we believe going forward also, we have very good pipeline of these the inventory. And as a company, we have been in the business for more than 28 years. And we think that we are very well capitalized, and we have done investments in the past, which we can reap those benefits in the coming years. And due to those cash flows, those we should be able to use to fuel the growth in the future, and also keep a cap or reduce the debt further.
Okay, so can you sort of lay out that roadmap for us? I was just going to get to that point actually. What is a debt equity ratio that you'd like to maintain on a going basis? You said that there's more cash flow coming in and you could reduce debt. So what number could it go down to? What is a comfortable debt equity position? And then what about funding for future growth? I mean, whether it's buying land and your other investments as you're looking at the launch pipeline, how will you sort of look at the cash and the investment for that?
Well, like I just mentioned, the cash flow that we are visualizing from the new inventory that will come in, that should largely fund the growth for the future, and hence our ability to manage the cash flow and keep the debt at these levels should be fairly good.
Very quickly, Jagdish, in Q1, the blended realization went up by 25%. Partly it's on account of the fact the company is selling more premium projects. But you also undertook a price hike, 17% price hike in Bengaluru, and Gurugram prices, I believe, went up by 40%. Do you think, the company will be upping prices again in Q2 or Q3? What's the view on price hikes from here on, and in which markets?
we are not here. Actually, stable pricing and incremental inflationary-led pricing is what we are happy with. Like I said, in the first stage of price increases had occurred in post-COVID, when the costs for the construction have significantly increased, and across board the industry had to take price hikes. And this mix has come in, wherein we had to increase we could manage better pricing because of the mix in the projects. We are not necessarily seeing a price hikes from here on, but at the same time, due to the mix in the change in the nature of the projects, if the average realization improves or remains steady, we'll be very happy with it.
Okay, got that, Jagdish. We will leave it on that note. That is Sobha at the end of the first quarter. By the way, got to turn our eye. Thank you. Got to turn our eye to the screen as well, because there is a wider decline that's now setting in. No taking away from that. The Bank Nifty is absolutely at that 50 DMA. We're at the day's low. Now this is looking like a weak morning, decisively weak morning. Nifty, mid-cap, Bank Nifty, all indices are lower. And for the Nifty, the problem is not only banks. Banks are down, yes, but as we were saying earlier as well, IT is not providing any support. A lot of your large cap IT names are down. Reliance is down. And the biggest of the FMCG boys, Lever and ITC, they are not helping matters either. So therefore, now this is a bit of a downward draft coming in for the market. Let's see if buyers come in right now, 19,500 odd for the Nifty. Let's take a break on that note. We'll come back on the other side. We'll keep the corporate conversations going. Kamal Gupta, MD at Jaikumar Infra, is going to talk about the company's Q1 performance. We will also be connecting with Sanjay Kumar Jha of Mishra Dhatu Nigam to talk about the company's show in the first quarter. Welcome back. Well, the screen's looking weak. We've been pointing that out. So we've got an eye on the Nifty and the Bank Nifty, but we also have more corporate conversations to go over. The next company on the radar is Jaikumar Infra. And that one came out with a pretty strong set for the first quarter. The company witnessed order inflows of over 3,500 crore rupees in Q1. The total order book now stands at above 14,350 crore rupees. The Intermajor expects to maintain the revenue growth of 15% as well as the EBITDA margin band of 14 to 15% in the current fiscal. Kamal Gupta, MD of Jaikumar Infra, is with us. So, Mr. Gupta, we've already spelled out the numbers. Revenue up 14, margins at 14.2, profits up at 18%. So, tell us what the outlook is. As you're looking at execution, in terms of top-line growth, what more can we expect this year? And how's the bidding going for future contracts as well? So what's the order book outlook as well? Kamal, I think you're on mute. Yeah.
So sorry. Yeah. Happy to share
yes,
another Jaikumar. As you are aware, and you told, like, we have got a very excellent and one of its kind project in Chennai, which is a connector of Chennai port to Madura well, which is a double decker access controlled elevated highway, and divided in 4 packages costing 3,570 crores. Taking to this, our order book today stands at like 14,351 crores. And we are very upbeat about the order inflows. Our guidance for this year looks to be 15% plus, that is 4,800 crores. And we are on a comfortable journey towards our vision for a billion-dollar revenue company by FY27 with an order inflow of order book of 20 to 25,000 crores. So
Wait,
the
if I
market
got
looks
you-
very good, and I can feel the air in the air. There is optimism in India, though the world is struggling with other uncertainties. So we are very upbeat and prepared for bigger challenges. J. Kumar is looking for bigger ticket size projects and more complex projects with a healthy balance sheet.
Kamal, just to clarify, you mentioned your order intake target for this year is a number just above 5,000, if I got you correct, right?
So our guidance initially was 5,000. So we have revised our target, and we are anticipating an inflow of around 8,000 crores.
Exactly.
Thereby to maintain an order book of around 15,000 crores by the year end of FY24.
Okay, so order book, order intake guidance for this year now stands revised to 8,000 crores, given that the first quarter itself has been pretty strong. Rima?
Would you like to revise your top line guidance to 15% higher?
We would like to give a conservative figure, but of course, we also see there will be the speed of the projects are improved. The margins will also go better. We are already L1 in more than 4,000 crores of project, which also includes the Goregaon-Mulund Link Road project, which is a twin tunnel. This will be the biggest road tunnel TBM machine in India, which is around 13-meter dia. So our share will be 3,100 crores. So of course, we are expecting a positive uptake in the guidance. So maybe it will go up than 4,800 crores.
Okay, all right. Mr. Gupta, since we were just talking about the TBMs, that's the tunnel boring machines, you'll be using them from line 3, but I think the Mumbai tunnel project could require bigger TBMs?
So we already have, Nigel, 8 tunnel boring machines, which are used for metro, 6.3 meter dia. So this project of JMLR will require a 13-meter dia, which is the road tunnel.
Correct.
So this will be the biggest TBM in India as of now, Nigel. So we have to buy that. We have already placed the order.
What is the total cost of that? I mean, and how many machines will you have to buy?
So this project is in JV with NCC. So 2 machines will be required, 2 TBMs. One will cost around 350 crores.
Right.
What are the kind of margins? You said the revenues, your share of the revenues will be 3,000 crore rupees for this Goregaon-Mulund Link Road Tunnel project. What would be the cost, the kind of margins, and the timeline? How long will it take, and when will construction begin?
So as you believe, we only take projects with 14 to 15% EBITDA margin. So we believe in a profitable growth. The timeline for this project is 48 months. We are expecting the LOI in another 10 days, a week or 2. So immediately after that, the work will start. It will take around 3 months to actually start the revenue from that project. But the mobilization and the planning has already been started.
Okay. Yeah, timelines for us, especially in Mumbai, are very, very important, Kamal. I can tell you, for a lot of us, we keep seeing your boards everywhere in the city as we travel. So really hoping that those projects get off the ground ASAP. But, I want to move to a different subject as well, and that is the sort of margins that you're getting. We understand that overall, the competitive intensity has really picked up in bidding. Tell us if you're also looking at that, if you're experiencing that. And in that context, going forward, when you shared an order intake target of 8,000 crores, which segments would you be targeting, not just this year, but even next year? Where are you still getting better margins? Is it metro? Is that the most profitable business? Will it be roads, tunnels, bridges?
So we work in a very niche area. We believe to take more complex engineering projects. So we are more into flyover, bridges, metros, elevated underground, hospitals, water, tunnels, roads as well. So I would like to say, I cannot say that this particular sector or this particular segment will generate more revenue. But of course, since we are working in a very niche area where the competition is comparatively less, and not like in roads. So, we are sure that we'll be able to maintain our guidance of 14 to 15% of operating margin. And all our projects right now, what we have secured are with 14 to 15% of margins.
Okay, all right, Mr. Gupta, thanks so much for stopping by, giving us that guidance. You're sounding extremely confident. The stock has moved to the high point of the day, so your shareholders will be happy. But all the three anchors out here are Mumbaiites, and we are hoping that, the construction, the activity, the execution picks up pace, because we are looking to more smooth travel rather than the trek that we normally see.
I stay in Parel, and there is this Delisle Road Bridge, okay? It's been under construction for 5 years now. And the deadline to open it has been pushed twice. So you can imagine the nightmare. That's the reason why Lower Parel is called Lower
I'm in the
Parel.
western suburbs, and if we keep talking about this, we'll have to do a full 1 hour show in Mumbai.
And it will be all complaints.
That's what the director told me, don't get Surbi started. Okay, all right. Well, that's about Jay Kumar, sounding very, very confident. The stock has moved to the high point of the day. But a stock that's trading a little bit lower is Midani, that's Mishra Dhatu Nigam, because the company posted a good set of numbers on the top line. However, margins contracted, and the stock is trading at a 52-week high. So that's why we're seeing some bit of a pullback. They're sitting on an order book of close to around 1,400 crores or thereabouts. So understand what's the way ahead. Mr. Sanjay Kumar Jha, the chairman and MD of the company, joins us on the show. Hi, Mr. Jha. Good morning. Thanks so much for joining in. Well, good execution is what we have seen in the first quarter. Now, the last time you joined us, you said that in the coming year, we're definitely going to cross that 1,000 crore odd mark. So wanted to ask you, for FY24, do you stick to a revenue growth target of around 20%? And also tell us, what should the margin band look like? Because that has disappointed the street.
Yeah, first of all, you can see in the first quarter, our sales have grown more than almost 60% higher revenue compared to the last quarter of earlier last year. But as you said about the pressure on the margin is mainly because of the raw material costs have gone up. And so this year this has affected in the quarter one. And many products which we have done in this quarter is all high-end products where we are importing the raw material at a higher cost. So mainly because of that, the margin is less. But as I'm sure as we progress in the coming quarters and all, we can recover this. And mainly other one is that finance cost also has gone up because of the high interest rate, which is already there for every company. So these are the two regions, I think, mainly, which has resulted in this type of lower profit. But
Okay.
I am sure that these things we can
Mr.
recover.
Jha, Mr. Jha, you're saying that the past quarter was impacted by raw material costs, but you're confident of a recovery. So give us a couple of numbers then. Revenue growth for FY24, will it be 20%? Will it be more or will it be less? And since margins will recover, what is the band we should work with? 25%, late 20s, early 30s? Give us a broad band, a 200 basis points band.
See, this quarter also, if you see, our EBITDA to sales is 25% more, 25.64. Last year it was around 35%. So 25% also is not a bad figure, but only since this company was going always more than 30. So expectations were higher, that it should be around 30. So now at this time it has come 25.64. That is the first thing. Secondly, the growth, sales growth itself in this quarter has been very good. And I am sure that this year, since you can see our order book also has improved in the last quarter, that means in the first quarter of this current financial year, we have almost booked more than 500 crores worth of orders. So order book also is going up, and I am sure that in coming quarters you will see that if the same trend is maintained, 20% growth is not impossible. Definitely will cross 20%.
Got that. Mr. Jha, can you split the order book in terms of defense and aerospace? And secondly, in February, it signed many MOUs during the aerospace show. Have those orders been converted?
Yeah, in fact, the order book position today, whatever order we have booked in the current this quarter, mainly it has come from the defense. So defense, when I say defense, it includes the aerospace also. So already that part is there, and second part is that export as indications are good. We have got, if you see our export figure, even though it is in numbers, it is hardly only more than 4 crores, but it was last quarter of the last financial was first quarter of last financial was only 2 crores. And I am sure that the type of order book we are having today of more than 35 crores, I am having the export order booked. So that will be also adding to our the earnings or the revenue in the coming quarters. So I am sure that the defense is going to contribute a lot, and defense excludes the aerospace also. And in addition to that, export is financial year export is going to contribute in the big way. So these are the two, I think, factors which will be responsible for the growth of the company.
You said exports are 35 crore of order inflows in the current quarter?
Yeah, already we have the order in hand, 35 crores. And we are trying to negotiate with more than 100 crores order is, and we are trying to negotiate now.
Okay, so what should be the ballpark mark in terms of exports as a contribution of your total revenues?
This year we are targeting around 200 crores of export. It should be around almost 15% of our revenue.
Okay, 15% of revenue. Got that. You briefly mentioned, sir, that borrowing cost has gone up. I'm guessing your working capital as well would have got stretched. So what's the working capital days? I think towards the end of last year it got stretched a little bit.
Yeah, working capital is the issue for us because of the inventory level is quite big. Because of that's what we are trying to see, that our inventory should come down, our work in progress should come down. So that efforts are on. And since our many products which we are supplying requires a long gestation period, processing time is long. So normally if you see in the Q1, Q2, you'll see the buildup of work in progress will be there. Otherwise, we cannot meet the requirement of Q3, Q4. So this is what that will be variation will be there because of our products are very niche in nature. So because of that only this pressure will be there.
Final question, Mr. Jha. You know, if I just pull up the last 1 year chart of the stock price, when it was around 200 rupees, when it was 250 rupees, 300 rupees, and now it's 350 rupees. I've asked you, the largest shareholder, could they be interested in doing an OFS? You have replied to me saying there is a possibility. Have you heard any kind of, sound bites on that front? Is an OFS likely, say, in the coming quarter? Because the share price has gone up drastically. And as you said, FY24 could be good. So have you got indications from the government of India?
It is under consideration.
But it was under consideration, sir, the last time as well. So is it likely in the coming quarter?
I am sure maybe this financial year they may go for that. But we are not having the control on this. Is done by the policy makers and then government of India. So depending on the market position, they will take decision. And I think that not only that Midhani, many other companies are also in the queue for OFS. So it is expected that any time it will come.
Okay, we will watch out for that announcement. Thank you very much, sir, for joining in and giving us some details on the business today. That is Mishra Dhatu at the end of Q1. Back to the markets, which are sort of reeling under a bit of pressure. Mitesh is with us. Mitesh, what's the call? What's the strategy now, looking at this weakness?
So, I've been kind of suggesting that there could be pressure from the higher side, and you could see some profit taking happening, and Nifty and the back could, see a lower level. So I'm penciling in about 19,400, 380 as the first target area for the Nifty, and if that breaks, in the worst case scenario, 19,200 can also be with it. So I think that's the kind of downside which is possible. On the stock side, IT still remains my favorite sector to explore long positions. So Tech Mahindra is a buy with the stop at 1195 for targets of 1250 on the upside. And a sell on TVS Motor, which I would recommend selling with the stop at about levels of 1335 for targets of around 1280.
Thank you very much, Mitesh, for joining in. Need to get into a short break. On the other side, we'll put the focus on commodities. Manisha Gupta is back with us.
Welcome back. Slightly weak cues from equities. Let's figure out what's happening in the commodity markets. Manisha is with us now. Manisha, what are you tracking? What's top of mind?
Well, I'm looking at the crude oil prices. So with all its ups and downs and volatility that we have seen in last many days, it still continues to hold around that 4-month high. So $86 a barrel is still on the charts here. We have seen prices move in a range of 1.5% to 2% for last couple of weeks. Now, having said that, it only has been making higher highs in the recent few days there. Well, the support comes in from the fact that Russia and Saudi Arabia are deepening their cuts from August into September, and expectation that they would continue to do that in October as well. That is something that we'll know in the first week of September. But at this point in time, the markets do believe that there is some tightness that could continue going forward. What is not working right now for the crude prices is the US output. That is expected to hit a record high in 2023 as per the latest EIA data. The last time we made a record was in 2019 at 12.3 million barrels per day. This year, the US output seems to be rebounding, jumping back, and 12.76 million barrels per day of a US output. So non-OPEC output in that sense seems to be increasing. The other thing that's not working is the US inventories itself. Well, last week was great because you saw nearly 14 million barrels of a decline, which was a record in itself. But this week, the API suggests that you could be looking at an increase in inventories. The other data that's not favorable is the Chinese crude imports for the month of July. That has declined 18.8% on a month-on-month basis. This is by far a biggest decline because in this year, for most of the months, we have seen the Chinese crude imports on the higher side there. The street is also watching out for the Chinese trade data, which hasn't come in so well. We've seen double-digit decline in exports and imports as well, and much more than what the street was anticipating on an year-on-year basis as well. So whether it's about weak global economic data, the strength in US dollar index, the Fed official statement suggesting that there could be another rate hike because the inflation numbers continue to be on the stronger side, and that's exactly what the street will be watching out for now. More Fed official comments are coming in today and tomorrow, and then you have the inflation numbers. The CPI comes in on Thursday and the PPI on Friday. So those two inflation numbers from US are going to be quite of importance.
Oh, absolutely. It is inflation data that markets will have their eye on. Thank you very much for that, Manisha. Well, let's come back and talk about, of course, the biggest cue that markets pretty much across equities, commodities, and, of course, the money markets will be tracking. The 3-day meeting of the Reserve Bank of India's Monetary Policy Committee has kicked off. A CNBC-TV18 poll shows 100% of market participants are expecting a status quo on rates. Ritu is here with the details.
Well, this monetary policy comes amid a sharp spike in vegetable prices, but easing momentum in fuel and core inflation, steady high-frequency indicators, and a divergent global monetary policy cycle. So the question becomes, what does RBI do amid all of these mixed signals? Well, all of the respondents to CNBC-TV18's poll expect the Reserve Bank's Monetary Policy Committee to prolong the pause and leave repo rates unchanged at 6.5%. In fact, the markets do not expect to see any more rate hikes in this entire financial year. The first rate cut is only expected in the April to June quarter of the next financial year, that is FY25, by 60% of our respondents, with some even expecting the cut to happen in the quarter before or after that. Now, in a status quo policy, markets are not really expecting much on the liquidity stance either. So the stance of the policy, which has remained at withdrawal of accommodation for over a year, is also now widely expected to be left unchanged in this policy. Food inflation is likely to drag the overall consumer inflation higher in July, perhaps even in August. So the CPI inflation forecast for the full year, which is currently at 5.1% on average, is expected to be raised, but only marginally to 5.2 to 5.5%. The RBI is also expected to leave the growth forecast unchanged at 6.5% for the year. Now, put all of this together with the mixed signals on inflation amid global uncertainty, and the governor is likely to sound more hawkish than not.
And it is that commentary that the market will watch out for very, very carefully. Thank you, Ritu, for the details there. Need to take a break, but we're not going away from this issue at all. In fact, we're putting the spotlight on the RBI policy meeting. Our special segment, It's the Economy, comes up after the break. Lada today gets chatting with Abhishek Upadhyay of ICICI Securities Primary Dealership and R. Sivakumar of Axis AMC.
Welcome to It's the Economy. As we just said, tomorrow's monetary policy is uppermost, although CNBC-TV18's Citizens MPC and what you just heard, my colleague Ritu Singh's poll, both indicate that the market is not expecting any change to rates and mostly no change to the stance either. Then what will the markets watch out for? Which part of the governor's statement and Q&A could move the market? For these questions, I have with me two actually market experts, Abhishek Upadhyay, the senior economist at ICICI Securities PD, and R. Sivakumar, the net fund manager at Axis Mutual Fund. Gentlemen, thank you very much for your time indeed. Abhishek, first, the ground questions. What do you expect RBI to do with inflation forecast? As you know, our own poll indicates that for July, inflation could be anything between 6.5 and 6.8 from the poll I did. Your thoughts on what RBI will say?
So inflation in July, we expect a 6.8% kind of inflation, and inflation for July-September is tracking above 6%. But from monetary policy standpoint, I believe, and from this policy, there will be focus on what RBI says about H2 inflation, and also for what projection they give for April-June 2024 inflation, which will be put out in the monetary policy document this time. Our own sense is that while near-term inflation is high because of vegetable prices, the outlook for H2 inflation has not changed materially. So we think that because core inflation momentum has been so soft with a 3-month annualized rate actually at 4.5% and below the YY measure of core inflation, even if there is some upside risk to food inflation, overall inflation can still be quite close to what RBI penciled in their forecast last time, which was around 5.3% average for H2. Possible this number can be tweaked slightly higher, but we don't expect material change. Even more important, April-June inflation, which RBI indicated in April would be close to 4.5%. That will be closely eyed. Again, our sense is that number should continue to be below 5%, given the inflation internals we have observed, and given some of the risks we were talking about earlier from monsoons, etc., have really not crystallized. Yeah.
No, what is your what do you expect RBI will say? Will they up the full year forecast to 5.3? Will they up the, as you say, April, May, June forecast for 2024 from 4.5 to what, 4.7 or something? Is that what we should be prepared for?
Possible for H2, the RBI revises its forecast by 20-30 basis points higher towards 5.5% or so. And for April, June, again, maybe they give a number between 4.5 to 5%, but no material change. If you get these numbers, it would signal and it would provide a cue to bond markets that RBI is likely to be on prolonged pause rather than leaning towards a hike, which is what is priced into the swap curve currently. Swap curve is indicating a good probability of a hike by, say, the December policy, which we still consider to be quite a low probability event.
Oh, this is big. I didn't know the swap curve is actually pricing in a hike. Then the reaction could be very different tomorrow. Sivakumar, good morning. Thanks for joining. What's your sense? What is priced? Is it true that there are sections which expect a hike by December? And if the number that RBI puts out on inflation, full year inflation, if second half is up by 20-30, full year can go up even more. It can be a 5.5 full year. And 1 year ahead could be probably, 4.7 or whatever. If these are the numbers, how will bond markets react?
Yeah, first of all, good morning and thanks for having me on. I think the most important thing is that inflation is still tracking roughly where RBI expects it to be. So yes, on food inflation, there's likely to be some upside marked to their inflation forecast, but I think that is something that the RBI will look through. They have looked through in the past. So unless they fear that this becomes generalized, this is not something to worry about. We must also remember that the RBI is working with an oil number about 85, which is, despite the rally in oil prices, is still where it is. So there are other parts of the RBI's forecast on inflation which is kind of bang on relative to market movements over the last 2 months. So I think the RBI is poised to stay flat. Having said that, I completely agree. There are segments of the market. If you look at swaps, it does indicate that the market is preparing in some sense for one hike in the next 6 months. I don't think that RBI will deliver that hike. I think RBI is mostly done. The risk is if they change their view and they believe inflation becomes generalized. That's one risk. It's a very low risk. The other risk which we need to definitely keep in mind is if the Fed puts in a September hike or later, then the RBI may want to consider keeping a spread to the Fed and keep rates elevated. So I think the market in some sense is trying to sort of play that game, that will the RBI react to an expected or to a potential September Fed hike.
Okay. Okay, so if they indicate that they are not doing that hike tomorrow, we could have a bond Diwali. I mean, you could see yields going down to 7.12 or 1 or anything like that.
You know, right now, if you look at the global environment for yields, it's definitely on the higher side. So we have, of course, the US 10-year has retraced significantly from the close to 420 levels that we saw earlier this week. Most of the bond markets seem to be catching a bit of a bit. But the underlying worry is that central banks are not done tightening. The move in Japan to loosen yield curve controls again has pushed yield expectations higher. So in the very near term, even if RBI holds this policy rates and the stance, I don't think we should see a significant move in yields. I think markets will wait for the next few months before that kind of a movement happens.
Okay. So the big point is, and we will all be asking the governor that, what are the chances of it becoming generalized? Abhishek, for that, some growth or aggregate demand numbers will also be watched. Do you think RBI will change its GDP forecast of 6.5%? Do you think there are upside risks to that number, given the very strong tax collections, very strong core sector numbers, and higher than expected growth numbers even in the US, quarter after quarter, month after month?
So RBI again is in a good place in terms of the ability to retain their growth forecast. We know that RBI's growth forecast has been higher than market forecast, but based on the GDP growth data for the Jan-March period that we got earlier and the high-frequency data, and add to that narrative of soft landing globally, most analysts have been revising their forecast up towards RBI projections. Still broadly, I think in our view, growth this year will be closer to 6% only. There is still a lot of uncertainty about how global demand will evolve. And our sense is with exports weakening, they can exert significant drag to this year's growth outlook. But RBI, from RBI's standpoint, don't see any push for them to again change their growth forecast. I think one point
you think they will go ahead, but also tell me whether you are expecting them to say things can get generalized. Please go ahead.
No, so don't expect them to say that inflation outlook has changed materially yet. So far, it is only vegetables. And if you look at inflation internals for the last couple of months, core inflation has been quite soft. In food inflation, there are pockets of concern, but broadly, thematically, as I said, monsoons have evolved more favorably than what many of us would have feared. Also, global food prices, while they have gone up a little bit, but still remain broadly well behaved. So as long as food prices are not going materially higher, and we don't get a new source of shock to domestic food inflation, don't expect them to say that price pressures are at the risk of getting generalized yet.
Okay. Shivakumar, all right. Now, you train our eyes. What will we watch out for, or what would you want to watch out for in the speech and in the Q&A? Liquidity, anything. What would you watch?
The RBI has, in that sense, been very interventionist in many places, right? So I think the most important thing is FX. The reality is that they have been intervening, they've been adding significantly to liquidity over the last several months. First, through the demonetization of the 2000 rupee notes, a lot of money came into the system. And then now, large-scale intervention in forex markets to stop the rupee from appreciating, which has again added significant amount of liquidity to the system. So I think liquidity is something we will watch for. They are very clear that in this withdrawal of accommodation stance, they would not want liquidity to get easy. So we obviously will be watching to see what they fail. I would expect they would not fail much. So to a large extent, this policy, I think, should be a non-event, non-controversial policy. And the surprise would be if they change any of these statements, either around liquidity or around the stance on rates, any of that. If they change, I think that will be the real surprise that we should be watching for. Otherwise, we should watch for much of the same. I would like to also sort of draw attention to one important thing, that the growth outlook for the RBI is very important. I think a lot of the reason that they have maintained the monetary policy stance the way they have over the last few years is to ensure that growth is supported. So because of, let's say, global environment, we saw the trade data out of China. We've seen some incremental numbers in the US indicating some kind of slowdown. If that kind of results in the external sector slowing down materially, I think second half of the year, we should expect RBI to tone down its language. It's too soon for tomorrow, but it's certainly something that we should be watching for in the next statement.
Okay, a lot of people are actually on the other camp, actually, that growth is in fact stronger than what they expected. Abhishek, a similar question to you. The consensus is that RBI is going to sound, will not change anything, but sound hawkish. You tell us what we should watch out for.
So in terms of the template, they will follow a similar template as the previous two policy meetings, where they retain the key policy settings, but continue to sound hawkish, both to retain that optionality to hike and also to preclude any premature easing in financial conditions. One thing, I mean, we are watching closely is potential action on the liquidity front. It has been somewhat puzzling that RBI has continued to add liquidity through the FX route, despite there being a sharp influx of liquidity on account of the recall of the 2,000 rupee notes. And core liquidity surplus, actually, if you compare to last policy, is higher by 1 trillion. Still, if you look at the weighted average call rate, which RBI tends to look at more closely, it is quite closely aligned with the repo rate. But there is that outside possibility that they could announce some sterilization measure to withdraw some of the core liquidity surplus that has been built up since last policy. Not our base case, because we do think core liquidity surplus will dry up by the end of fiscal. But there is that risk that they may take some action, perhaps a FX swap auction, to suck out some of the FX liquidity they have injected over the last couple of months.
Oh, okay. In which case, the markets can be a little upset, I guess, the bond markets. Gentlemen, out of time, thank you very much. We will seek your help to understand how you parse the governor's language. This time tomorrow, he would have delivered a speech. So we will want to know how he parses. But only on liquidity, a lot of bankers tell us that now you have this 24-hour NEFT, and therefore they need some at least 1 lakh crore at a system level just to meet those payments. So at least I would like to know, what does RBI mean by balanced liquidity now? 1 lakh crore is par for the course. They need to keep a little more than that. So over and above that, if they withdraw this liquidity, Abhishek, then maybe the market will take it as hawkish. But all those questions tomorrow to you and to a whole lot of experts. Gentlemen, at the moment, markets very placid, bonds as well as equities. Equities actually a little downbeat. We'll wrap up on Bazaar on that note. Chartbusters up next.